Let me know you guys can hear me okay, and you can see the screen. It looks like that's good. All right. What? Less than usual crowd today. I know today's no, Super Bowl is tomorrow, but market might have shaken out a few people. That may be one possibility. We had a volatile market this week, but essentially it was nothing burger. So what else did you see? Anything to share? What do you want to talk about? What's on your mind? Let me just make sure. Okay. All right, nothing? We can all go back home? Nothing to discuss? Come on, give me some idea. So I do want to talk through some of the earnings, but interested in how, what was your situation this week?
I'll say this. This is Matt. This week was a little scary because of cryptocurrency. Bitcoin and Ethereum kind of crashing, and who knows if it's the bottom. So next week, I'm anxious to see what happens with that cryptocurrency in the tech sector, AI, everything's going down, and then all of a sudden Friday, everything went up. Uh, because I'm sure everyone's transitioning into the value stocks.
Yeah. You're right. Bloodbath except Friday. Yeah. And my or X feed was full of, the market is in, downturn. There's a bloodbath. Why the stocks are falling, and is this the end? Is the bull market over? And all that stuff. So yeah, I think it's all depend on portfolio positioning. So we will get into it. There was a sector that got killed. Market was still okay, right? So market metal too. Yeah, gold, silver, I think they all got punished as well. It was almost at some point of a time started to feel that it was a incessant selling. Means it started with software, and then you start to see the metals are being sold off. Crypto is being sold off. A lot of stocks getting sold off, and sometimes to me it just looked like maybe there are some traders or funds that are just getting margin calls, and now they will sell whatever they can and not what they want to. And so it was an incessant selling on some of the, even the good, I would say, companies as well. It was like SaaS was given for that. All right, so I guess yeah, at least we have some quorum. Let's get started. So we will talk about SaaS software. Alan and asked for Coupang. I'll talk about Coupang. I mean, I did not have it on my agenda, but maybe we'll start. We can start the discussion with that. It wasn't a scandal. It's just that they had a data breach. Cool. Anything else on mind? Let me take a note that I need to talk about Coupang. What else? Any other specific thing? So SaaS is already on agenda for today, so we're gonna talk about that. Any specific earnings caught your attention? I'm gonna talk about Amazon, PayPal, Palantir, Google, Uber. These are on my list. Maybe give a quick overview of the earnings. All right, how many of you hold? Let me ask. Palantir. It's a pretty favorite retail stock. Palantir shareholders here? None? Ramesh says my son holds Palantir. Sridhar holds. Nitesh says yes. Niyanka yes. Okay. So yeah, it's been a I'm so one of the great winners over the last 2 3 years, but this also got smoked. Let me ask, who are shareholders of PayPal? PayPal shareholders. Looks like I'm the only one. Aditya, okay, Aditya, is there a Nitesh?
Unfortunately, yes.
Oh yeah, you ask questions on PayPal,
With
right? Yeah.
deep regret.
Uh, it looks like there's no bottom to it.
Yeah, yeah.
Yeah. Okay. So we will talk about PayPal. Let me see. How about Uber? Something that I long back I think mentioned undeletable app, or it's becoming better and better as a business. Yeah. Okay. All right. So we had a lot of turn if you realize, but we in this earnings report, at least out of these five, we had two companies where we had executive changes, right? And I was like, what the heck is happening? Market has, I mean, no patience. You want to, give the management 2 years, and if the stock price doesn't work out, you throw them out. So we saw two companies where we had a management change. And I assume, Alphabet and Amazon, everyone have in their portfolio. If not direct, you'll have it because you own SPY or QQQ, or if you own any of these big market ETFs, you have exposure to Alphabet and Amazon anyway. Cool. All right. Um, which other earnings caught your attention, or something that you were big in your portfolio and I don't have it on my agenda? Okay, all right. So looks like we got all that covered. All right, so let's get started. Okay, welcome everyone to our discussion number 311 for talking about investing every week, every Saturday, and hopefully we'll continue till we reach four figures. Let's see how much energy I have, but thank you for showing up every week and helping me and other members become better investors. So today on agenda is, of course, we still have earnings season, so I'm gonna cover some of the earnings: Amazon, PayPal, Palantir, Google, and Uber. And other big topic will be to look at the SaaSacre that happened, or call it SaaSacalypse, wherein a lot of these software companies got smoked, and not just the software companies. The I think the fear spread to a lot of essentially every other high beta company, right, which have a revenue far out in the future. They all got smoked. So we'll look into that, see, look at as a sector, see where the valuation is, and things like that. Look at a crypto, because crypto wasn't immune to whatever was happening in the regular capital market, and that got smoked too. A Bitcoin fell down to maybe 63K, and before it recovered on Friday to get back up to 70. And then today morning I looked at the coin Gecko, and it is back to I think 68. This market is always volatile, so doesn't really matter. Maybe I think I jinxed it. Was it last week or week before that? We were talking about this crypto market and the Bitcoin, and I said, hey, be ready for 50% drawdowns. I think 50-60% could still happen. I don't think 80-90% drawdowns will happen now, because of different kind of money that is now some permanent money that is coming into the Bitcoin. So maybe I jinxed it, and we saw what 44% drawdown in Bitcoin. So yeah, if you want to be in this ecosystem or in this asset class, you gotta have a really long time horizon, and I guess mental and the financial fortitude to go through these drawdowns. And if I recollect, I think this was 7th or 8th, or maybe more, 40% drawdown in Bitcoin. So you've been watching this space for a long time, then this is how it is. Nothing new. Uh, and now I think it is recovered. But there are other companies, and we look at some of those companies, those got smoked, right? Especially the digital asset treasury companies. So we'll talk about it. All right. So let's jump into today's discussion. As always, don't take it as a financial or investment or tax advice. This is just for education and entertainment. Always, I want to start with some thoughts around investing. And like at the beginning, some of you mentioned there's a bloodbath. I was seeing similar stuff on my Twitter feed. And but essentially, if you really look into it, there's nothing that has, I mean, it's nothing burger, right? So SPY was like essentially flat year to date. We're looking, and let's we go to, so all we are complaining about markets in bloodbath and all that is probably a lot more to do with our asset allocation and our choice of what we want to hold in our portfolios. But I think it recovered on Friday, so it's actually positive. Forget about flat; it's now positive for the year. So nothing much has changed, right? And I did put out a post saying if you're feeling a lot of anxiety, if your blood pressure is shooting, maybe look into your portfolio. It was a time to introspect in terms of what you hold in your portfolio. And I think many new investors or many investors that have come into the market only after 2022 probably learned the lesson a little hard way and maybe figured out first time what type of companies do they own in their portfolio. And I did see some other folks complaining about their portfolio down like 30%, right? And complaining about market, maybe the market is rigged and all that stuff. Guys, you need to know what you own. And if you have owned, I mean, I own some of the stocks which are like high beta, high growth stocks, and got hammered too. But if our entire portfolio is only high growth, and over the last 2 years, 3 years, we could proudly flash our triple digit YTD gains on Twitter. This is the downside of it, right? When the party when there's a concern or when there is a spanner in the party in the wheel, those high beta stocks also come down as fast as they went up. So if you are feeling anxious about it, if you are thinking, gosh, this is not for me, like I've said in past, there is no shame in owning index ETFs, right? I think in 20, not in 20, in 2000, S&P was down maybe 10 or 15%. Whereas we talk about 2000, how bad 2000 was, S&P still did fine. It was a sector-specific drawdowns. I mean, even this time also we were seeing some sector-specific. Even if you look at the sector-specific, in that term, even QQQ, which is a tech sector, is still okay, right? Look at a YTD, it's almost no change. So I guess if you like a lot of people who are being hurt by the activities or the market gyrations of this week or because they own some specific type of securities and maybe the whole portfolio was similar securities. We were really not diversified, even though you had a different tickers, but those all were so highly correlated that they all went down together. So maybe look into your portfolio and absolutely fine to own index ETF, stay a little diversified, and yeah, life will be good. The idea is it will help us to stay longer term. We don't have to liquidate our portfolio, because if your portfolio is down 30% and then you have an expense coming up, you gotta realize those losses, right? So if you felt really hurt in this week's market tantrums, I will highly encourage you to introspect and have a deep look in terms of what companies do you hold in your portfolio. Okay. All right. Anyone had a company which is down 50%? You don't have to mention me the company. You don't have to also tell me in terms of how big is a part of your portfolio, but whole a company, MSTR holders were in for they did recover on Friday, but they were in big pain. As long as it's not a big part of your portfolio, and this is where the position sizing comes in, right? This is where I hate when people say, which is the stock that you will go all in? Not even a single stock. I don't care how attractive the stock may look like, but I'm not going to go all in into any single stock. Robinhood. I don't own Hood, but let's see how did Robinhood do this week. Hood. Okay. Yeah, it's been up pretty bad days from $100 to almost 30% drawdown, 25-30% drawdown. Oracle, almost same is the case with Oracle. Let's go back. 18%. Let's do the 1 week. Sam, you have your hand up. Go ahead. What's your question?
The worst day, I lost 35,000, and thanks to you, that's only a little percentage of my portfolio.
So I'm assuming that your portfolio was down 35,000, or did you realize the loss?
No, I didn't realize it, but
Okay.
it went down 35,000. That really man, that's like 3 months of expenses,
Oh,
4 months of expenses.
sure. Yeah, absolutely. So one thing which I did was this week, I was tempted to buy a few stuff, and I did increase my deltas. But before that, I moved some of the cash out of my brokerage account to my bank account, so that I don't have any issues in paying bills, right? So I'm like, let me move some cash, and then let me then add or buy or some other stock or ETF I thought were smoked and probably didn't deserve this treatment. I could be wrong. But that's okay. Well, that's what investing is. Yeah, paper lost many times. I remember during the liberation week, I think on some one particular day, paper was down 6 or 7%. Right? But then, as long as you can hold through those drawdowns, we came out really strong. Right? This is why it's so important to focus on the drawdowns and not just on average returns. Because average return S&P is 10%. We've heard every financial media talks about it, but there are maybe 4 or 5 or maybe less than 10 instances over the last 100 years where actually return close to 10%. The problem is those 30% drawdowns, 20% drawdowns that are inevitable to get to that average 10%. And if we cannot withstand that drawdown and we have to sell our holdings, then there is no way we can actually enjoy that average 10%. So do whatever you want to or you can to make sure you can go through these drawdowns. And this is the price that we pay. Volatility is the price to pay to make more than treasury rates. Otherwise, yeah, you can invest in treasuries and be happy with whatever those risk-free returns are. Unfortunately, we want to make more money. And if we want to make more money, we have to take this volatility. All right. So yeah, this was then I went ahead and looked at last 4 weeks. SPY has hardly moved over last 4 weeks. And not just this week. Over the last 4 weeks, nothing has happened at an overall market perspective. Right. But like I have been watching, and if you've been watching markets, and many of us trade on daily basis, oh my God, our ECG, those readings were going off the chart because the market has been pretty volatile. So, and I think we were joking in one of some WhatsApp group saying, hey, if you guys have gone out and never looked into a brokerage platform, you're pretty safe. Your heart will thank you that you didn't have to pressurize it to go through these drawdowns. Anyway, early moments can be brutal. So I love this phrase, when in doubt, zoom out. Right? Whether it's year by year, hour by hour, month by month, or year by year. Sometimes year by year also we see a lot of volatility. But if you really zoom out, market is a reflection of how the economy is progressing, and which is generally we continue to increase. So stay invested. Figure out how you can stay invested. Jitendra saying, selling puts on stocks you really want to own. I sold puts on Microsoft, which I'm bullish long term. I actually bought Microsoft this week again. Last week I told you, go through the section of what did I buy or sell. So I bought Microsoft last week. I also added to Microsoft this week to my position. Anyone bought SanDisk and KLAC? SanDisk not for me. I didn't buy KLAC, but I did sell a put on SMH because I don't want to buy. I don't know. I mean, either I can buy small positions in KLAC, AMAT, all the companies in the semiconductor value chain, or I thought was rather I'll go with SMH. So I sold a put spread on SMH, and that was pretty close to money because it was, again, SMH also got hammered down. So I sold some puts put on SMH. So what else? So now we're looking at least over the last 6 months, old economy is a new economy, right? Or the things that have worked, oil and gas, transportation, chemicals, where things that have not worked is software, right? And this is where having little diversified portfolio will save us from a lot of grief. When I say diversified, actually also that the sector diversified, right? So sector wise, energy is the top sector, 17%. Consumer staples, and I had a strangle on XLP. Now the call side is in the money. I'm like, what the heck? The consumer staples is actually trading at more expensive valuation than software sector, right? Now the pendulum has swung completely to the other side. Not the first time, won't be the last time where we will see the market, swings, and when the sentiment changes, we swing too hard on one side or the other. First it was software. A lot of companies in software space were trading at crazy valuations, and then we hit them hard this week, and now staples is trading at such a huge valuation, right? Overall S&P 500 still nothing burger. I think there's a difference in terms of how Fidelity calculates YTD versus how Google does it. So it does show 0.69, but essentially it's an unchanged, right? Doesn't matter 1-2%. So if you just held S&P, life is still good. The things that are not working is information technology. I'm surprised to see that the financial sectors is down. Because generally when the money moves towards these value-oriented stocks or value-oriented ETFs and all that stuff, financials is a big part of that. So maybe a recovery in financial will be coming. Maybe this is lagging the recovery of those value plays. But I'm a little surprised to see that the financials are down. The other thing I was surprised was on the consumer staples. But I did watch. I thought the XLP will somehow, maybe come back. But look at the movement. This is the consumer staple. This is like selling sauces, like tomato ketchup or your cereals. You're not gonna grow suddenly the demand for cereals and the ketchups and your food and the groceries, but so much. But yeah, the stock is up from 76 to 88. Right, that's like almost 20% in a month. Crazy. Probably I'll not defend my covered call. Let it be called away. To me, it seems like now the pendulum has swung completely onto other direction. Sam says, oh, Jitendra asks, SMH or SOXS? I have SMH. I don't know. I've never owned SOXS. Anyone can tell me what's, I've never looked at the comparative. It's in terms of, never did a comparison between SMH and SOXS. SMH. Is there a difference in terms of which companies do they own? This seems to have a better option pricing, better liquidity in options. SOSX, the SMH is better from an options perspective. The liquidity and the interest from an options trading on SOXS is less. Asif saying more tickers in SOXX and less percent weighted for NVIDIA. But yeah, but I think the fact that there's more liquidity and tighter spreads on SMH, I will stick with SMH. Intel disclosed that, okay. Well, that's fine. I mean, you can look into the filings, and I generally don't pay too much attention on the management buying or selling, specifically on the selling side, because they will sell for a lot of purposes, unless they've completely reduced their overall holdings, then I might get concerned. But I think they owe to their own families to diversify their own holdings, right? If you are a founder CEO, and 90% of your wealth is tied in your company, I think it is a prudent decision to maybe lighten up a little bit, right? But don't sell 50% of your position, because then that get me worried as a shareholder. But if you sold a little bit of it, I don't pay much attention. When selling covered call spread, do you also close them to 50% max profit? So I immediately put a GTC order at 60%. I think I moved up my target from 50% to close to 60%. And then, this Friday, even if some of the February trades were not at 60%, I even closed some of my trades at 30%, especially the short calls, the hedging trades, because I'm like, the market is already, some of those, the QQQs, they already fell down. And then on Friday, even though the market went up on Friday, the vol got crushed. I think the VIX was down maybe 17% on Friday. And those short calls immediately become profitable in like, I regularly put in, I put in like 3 days ago, 2 days ago, and they were up like 30% of max that I can manage. Like 30% in 2 days, I'll take it. But yes, I will close it at 50 to 60% of max profit.
And this is typical discipline that you try to follow.
Yeah, so immediately I'll put in a GTC order. Yes.
Right.
Because I don't want to be sitting and then,
it gets called away.
Watching and doing everything. So once my opening trade goes through, I'll put a GTC closing order at 50%. If it is a if the strangle 50%, short put 50%, short I mean spreads is 50%. If I'm doing an RN butterfly or a straddle, then I have update from 20. I used to be 25% now, but I have it at 30%. So I'll immediately put at GTC at 30% of max profit. Yeah. And then, if it is, let's say I'm getting close to now 3 weeks, 2 weeks to expiration and still has not hit the profit target, but if it has made 40%, I'll close it and I'll put it for the next month. Like already started building, not already, I have been building now March portfolio. So a lot of trades, I mean, the ones which I'm closing for February, I'm opening it up for March. Now it has become like a pretty standard, I would say, my business activity, right? In terms of, okay, now we are approaching March. March is like 45 days out. I start opening positions when it is around 60, 55 days out. And then as I close Feb, automatically, not automatically, but mechanically just open up the positions for March. What about when our options are in a loss? Yeah, if I'll roll it out, if I still have the same thesis around the company or my position, then I'll roll it out. Right? Some of the, let's say, short put were at loss, so I wanted to give myself more time. As long as I can get a credit to roll out, I'll roll it out. And then I rolled it out for March. Probably if you look at some of my trades, I might have put a comment saying, hey, this roll out these trades. Because now February it closed, it's pretty close. And then March is how many days out? March is 41 days out. Yeah, so it's a good time to start putting positions. But I still have a lot of February positions open because the VIX jumped higher and many of those positions have not yet hit the target or at least the profit that I want to take from them. Or otherwise they are helping me in managing my overall delta. Then I won't touch them. And sometimes it's not just that you have to win on every position. I'm okay to lose on a single position or a trade as long as it is helpful in overall portfolio delta management. Right. So if I have a negative delta trade, which I'm for February, I probably will still hold it.
Vivek?
Yeah, go ahead.
I sold 3 of my puts, my on Alibaba. One got bought out and it was out of the money. The second just expired, so I earned a little bit. But then the third one, I bought the sold contract back. How did I do that? I earned a lot of money from that, buying it.
No, so if you sold it, then you bought it back, you basically close the trade, right?
Yeah, how can I do that? I didn't know I could do that.
Or I don't know which your trading platform is, just do the reverse of it. If you sold a put, then go to the same strike price and buy the same put.
Yeah, so I earned like double, maybe $6,000. Well, excuse me, I lost a lot more on, but I couldn't believe it. I bought my own contract back.
Yeah, yeah. I mean, yeah. This I most of the time I'll not let it assign and probably close it either at a profit or at a loss. Right.
Yeah, I'm on Fidelity, but I just couldn't believe that I could sell it and then buy it back.
Oh yeah.
Thank
All
you.
right. What else? Okay, let's continue. Where's the document? Looking at a fear and greed index, we were in a fear, then moved to neutral, which is okay. I will, still open positions on this. I stopped opening a lot more bullish positions when that needle moves to the greed or extreme greed is where you where you you double down on reducing your deltas, but that's okay. I think the crypto was still in extreme fear. So if you want to go long on some of your crypto positions, right now is a better time than anything else when the market is in fear. You can get much, much better pricing when no one else wants it, right? If everyone wants a particular goods or assets and you're competing with them, you're never gonna get a good price, right? But right now, no one wants crypto. So you can get them at much better price, assuming that you have your thesis still intact. If your thesis is broken, then yeah, stay away from it. So let's talk about SaaSacre. Before that, let me see if there are any positions that I rolled since you talked about it. Yeah, see Amazon. Amazon I had a short put for expiring on February, right? And after the earnings, it is 215. I actually had a strangle 215 and 270. I think I rolled 270 to 245. Then 245 I closed. After the earnings, I closed it at 4 pennies, and because the stock fell down. But I'm still bullish about Amazon. So I just want to give myself more room. So I basically rolled it out to March expiration and got additional credit of $2.64. So Ankit, to answer your questions, what happens when the options are in a loss? This was in a loss, but I'm still bullish about Amazon. I think it should recover, and maintaining the same bullish thesis, I just rolled it out from February expiration to March expiration. Right. Like ASML, Feb trade close, open March, so pretty mechanical, the standard stuff. Okay. All right, so let's talk about SaaSacre. And I think I hold some of these stocks. You might be holding some of these stocks, which is a Microsoft, Oracle, all those names that we have heard. And this is basically a list of stocks, I think top 25 from the ETF IGV. And it was not a pretty picture. But still, it's not a pretty picture. Microsoft is down like 75% year to date. Oracle is almost one cut in third. Same is the case with CRM. Even though we had some recovery on Friday, look at Adobe. Adobe is like 1 year change is almost down 40%. Right. So all of these stocks over this week got hammered because, and some people say because. Let me ask you, why do you think this got hammered?
Or
What
AI.
did you notice?
AI?
Yeah, AI has been around. What happened this week in which
Anthropic.
And well,
Anthropic came and said they were going to displace all the software with releasing the legal software, right? Legal automation.
Yeah, they released a legal plugin or whatever called module or something for legal industry, in which they mentioned, hey, it can do the job of reviewing your contracts in the context of your company and all that stuff in market. Oh my gosh. Then all the software companies are of no use. If Anthropic can do it, they can do it for legal industry today, they can do it for another industry tomorrow, and then start to punish. There are some legal companies that got hit hard. There's something called LexisNexis, or can someone remind me? Okay. There was a LegalZoom. I'm just looking at which one of these are publicly traded? These are publicly traded. LegalZoom, I heard that okay. Right. LegalZoom. There are companies which just provide the data services. A lot of these data services companies got hammered because like companies like Thomson Reuters, that got hammered. I think FactSet, that got hammered. So, and then once these companies some stocks are down 20%, 30%, and then if there are some funds holding it, they'll have to liquidate some of their other positions, and then they start to go down, and then suddenly you realize it's starting with the legal industry and the data services industry, and they spread to a lot of other softwares, because you're wondering, my God, if it is going to displace legal, it's going to displace other things tomorrow, right? There are things which are 30% drawdown. Overall, if you look at it, great chart from the compound. Yeah, you should watch their YouTube. I regularly watch it. They bring some great charts, right? So application software, overall, right now it's like 30% drawdown, right, from their high, which won't be surprised. We looked at the start. We looked at how the software is doing, and that chart from Bloomberg was like 26-27%. So pretty, I think it's a fair chart in terms of looking at these tickers. They're down 30%.
So Vivek, the other
Staples.
thing. Sorry.
Sorry, go ahead.
Can I quickly comment?
Yeah.
Yeah. So the other thing I read is just a headline. I didn't read the detail. Is they came and said they are going to go after legacy applications. Right? Generally, AI is is for new applications. And Anthropic this time came and said somehow they are going to refactor the legacy applications.
Mm-hmm.
I thought that's why the ServiceNow and Workday and all these guys got hit, because they're all legacy, like traditionally written.
Yeah, now is down 34% for the year. Yep. So, right, I think the overall market was thinking that if you're building, and I think I also had posted probably in one of the chat, that my thinking is, if you are just a layer on top of the base data, you are not the owner of generating the data, the business data, but you are build a nice UI to derive intelligence out of that data, then you're in trouble. Like companies like Monday.com, right? They're in trouble because you can have all your deadlines, etc., on your Google Calendar itself, right? And Monday.com basically allows you to create tasks which you can have it on your or a system that you use for your daily work, and they don't provide any value. They don't own the data, but allow you to make use of it in a much nicer, friendlier way. Things like that are easy to disrupt, and you don't need. And now the end customers can probably, the companies can probably create customized software at much lesser cost, because the marginal cost of software development is going down. But as always happen, we always throw babies with the bathwater. All the stocks got hammered. Some of them probably did not deserve to be. Like CrowdStrike, I don't know why CrowdStrike. Because why CrowdStrike got hammered? It's just not, I mean, you don't have the domain knowledge, right? You need to have that domain knowledge to build the cybersecurity software. Unless you have that domain knowledge, I just can't vibe code it. So there's some company that got hammered, and I think there was a chart probably later on. I think that came from OpenAI in terms of how they plan to disrupt this space. Another chart from Compound. Staples and tech are near trading at the same forward PE, right? Almost 23, right? Which happens only when when the overall markets are bad. Like 2022, we saw this. We've seen this around 2018, close to end of 2018, when the markets, I think SPY was down some 10-15% in the last few weeks. Otherwise, This one after the crisis, this is the forward PE, right? But now both are trading at the almost same. Staples and tech P's are now diverging. Diverging in terms of they generally tend to ebb and flow in the same direction. But now the software P's, forward P's are going down, whereas the staples is going up. Right? We haven't seen this divergence before, right? Over the last 5 years, but now it is. And what else? I think this was the news, and I saw it reported in media outlet. New AI tool hammered some software stocks. This is what, when they came out with the legal plugin, hammered a lot of these tech stocks. But if you look deep into this, what the miss was, this was kind of a connector. Even if you use this Claude plugin, legal plugin, you will still need to have it will still connect to your Slack, it will still connect to your Salesforce where the contracts lies, it will still connect to your Box or Google Drive or Microsoft OneDrive where actual contracts are there. So it doesn't mean that it basically it renders these other softwares unnecessary. There is no custom code, no legal database, no proprietary engine in this one. They will still need to understand the context in which you're operating or your company is operating. They still need to understand how your customers, your history has been. Right? So all those things will still be there, which you will still need. Your system of record, your rules and procedures, your governance criteria, your compliance requirements. Claude has none of those. But yeah, when market swings into one side, it just probably went way overboard in terms of how this is gonna disrupt, and all the stocks got hammered. And once that started to happen, all other high beta companies, some retail favorite stocks, they got smoked as well, right? Iron down 22% for a week. Some of you talked about Hood. Hood has nothing to do with these AI stuff. It's a financial services company, got smoked because it's a high beta, high growth. Now if you have to raise cash, probably you'll sell off these first. Coinbase, different story. Crypto, I think Robinhood has something to do with the crypto. And I think that's why now Hims and Hers, never owned it, down 15%. You can go down the list, Oklo 10%, so on and so forth. CoreWave, all these retail stocks also, retail favorite stocks got smoked as well. During these days, what worked this week were things like Berkshire Hathaway, Schwab dividend ETF. These are the times when you realize why you should own some of these old economy. Even if you don't want to get an exposure to a particular company, Berkshire Hathaway is kind of an ETF, right? They own multiple businesses in old economy, from energy to railroads, to ice creams, to fasteners, to paints, to oil fields. So it's kind of an ETF, and Berkshire Hathaway was, it started behaving like a meme stock for the week, right? And same is the case with SEHD. SEHD basically hit a new all-time high this week, while all other stocks were getting smoked. So it helps to have a little for diversification. And I think I've talked about SEHD. I'm not a big fan of a dividend paying company. I'm not a big investor for dividend capture, but I just hold SEHD because it provides you that balance in case when the market is in turmoil. You never know how long this turmoil can be, so I'm okay to hold this. And when the markets are doing good, this generally will underperform, and I'm okay with that. So want to share this where I think again a lot of concerns come out from this, that this is coming from OpenAI, right? Says you have your system of record, business contacts, agent execution, all the other stuff can be managed by your agentic workflows. Right? Give them enough context from your system of record. So the whole idea was, unless you are a system of record, there is a high chance that will get disrupted. So, but let's say, for example, I don't know, I do want to own a position, but I'm very careful in terms of adding a single tickers, individual tickers. But let's say SAP. SAP then owns the system of record. Right? That's where the initial data generation happens in an SAP software. And that got hammered. I mean, there was an earnings also, but that got hammered too. Right? Stuff like these, you may want to identify either they are a system of record or they add a value to it because it's a highly regulated industry or related to compliance regulations. I think those companies will still be able to survive, will fight back. But if you're just a wrapper on
So,
making it
David,
convenient
so that will be the
wrappers,
same with the ServiceNow? Same thing too,
which
right? I
one?
mean, ServiceNow, both ServiceNow and SAP, I hate. I think the software is so clunky. But I think to your point, I mean, you have all this compliance and processes deeply ingrained, and that's why it makes it very difficult to switch to another system, right?
Switch first
Or
is
transition, or in other words, to transition. Say you're a corporate, you're an enterprise corporate company, right? I mean, SAP is it's, in my opinion, it's very complicated, but you have so many processes behind the scenes. Once you embrace it, right, it's millions of dollars investment in there already. And then it's highly unlikely that you can just, say, hey, I hate this system. Let's go to JD Edwards, right? It can be like that,
Oh
so.
no, you cannot just rip and replace SAP. I mean, we are still running mainframes in our banks, even though the tech is dead. It's very difficult to rip and replace these entrenched systems. Right? So I don't
So the
think.
point, so the point right here, then SAP and ServiceNow may be good time to dip in a little.
Again, I've not looked into the valuation of SAP. The problem that SAP have been going through over the last few years, and I should have taken a position when that problem was, evident, was their transition. They were transitioning from the big clunky, install systems which takes years to install and configure, to more of the becoming cloud friendly. So they were doing SAP HANA, right? And last when I was looking at this, somewhere here, um, I mean, it's been a little bit volatile. I've not looked at SAP over the last 2 years, but at that point of time, they kept pushing the dates of their cloud release till 2026, etc. Maybe I don't know where their status is, but yeah, if you follow the company and it's available at a nice valuation, I think the fear of AI, that AI is gonna or these agents are gonna disrupt SAP, I think that is overblown. I don't know about the rest of it. They've been working hard to create a cloud version or subscription version of their software.
Okay, sounds good. Thanks.
Uh, Salesforce got hit. Yeah, I mean, Salesforce have had their other problems. I think they've been hit even before the SaaSacre of SaaSacre of this week. But okay, Salesforce is also a system of record, right? Now, the question is, they may not get disrupted, but they will not be able to command the same premium that they have been able to do so far. I think that's a challenge which market has. And if you are a traditional, do the valuation the way Street does the valuation, the way analyst does the valuation, you do your discounted cash flow in which you project the cash flow for next 10 years or 5 years, depending on the company's or the firm's policy. And then you apply a growth rate for till eternity, and then gather all those cash flows and discount it to the present value, right, using a discount rate. Now, the majority of the value, majority of the cash flows come from the terminal rate, right? Not the 10 years, not the 5 years, but after 10 years, the company is in business for eternity. That constitute the most of the cash flow, most of the valuations come from there. I think without the concern that the market has is, do that terminal valuation still exist the way we thought it would? Maybe for next 5 years is still okay. But I think what the market concerned is that because the cost of creating a software is going down like a rock, there will be a lot more competition that could now spring up, even in the industries that are now currently have a system or systems of record, that they will not be able to command the same premium or be able to grow at the same rate that the models have considered while driving their terminal value. Right? And I think in some cases, I think Chamar said that consider that your terminal value is 0. Right? I think that's another extreme. But every model is now questioning that I've assumed 2% growth rate, 3% growth rate in terminal value, right? And whatever the free cash flow growing at 10%. Will it be able to? Will it have the same pricing power to grow the free cash flow as 10%? If not, your terminal value will decrease, and that constitutes majority of your valuation. That's the re-rating which is happening. So even though companies like Salesforce will survive for next 5 or 10 years, they will have an increasingly difficult time in getting the same revenue or the growth that we've assumed. The other thing is most of these companies are on per seat basis growth. Right? Now, how do you'll have to change your billing metric to figure out how do you work in an agentic world. There's one agent, mega agent can probably because agent can work 24/7, right? You don't and can do the job of 10, 15, 20 people. So how do you price for that? It's a bigger question. So you may not, and we are seeing this happening, right? Amazon is laying off people, Microsoft is doing the same thing. You don't have those seats anymore. And if all your pricing was based on or revenue strategy or business model was seed-based pricing, that goes out of the door. So there are so many variables, and that's what market is thinking. They don't know how to price it in future. What will be we cannot assume that these companies will continue to grow after 10 years, 15 years. That's the biggest concern. And nobody knows what's going to happen. I don't know. I don't think the market knows it. So a lot of people, I think that's where a lot of investors got scared and sold off these companies.
Vivek Bhai, just something to share there. I think, and again, take it with a pinch of salt, but they'll probably come up with something similar to their charging models with APIs, where you just sell a bundle. You call me it's $200 a month per 50,000 calls per month, sort of a model. So it depends on how many times you call my agent and the sort of the output. I imagine they'll probably copy and paste the same model.
Yeah, all of them have to move to a consumption-based pricing.
Yeah.
We started to see this consumption-based pricing a few years ago during the hyperscalers.
Yeah.
Right, when they went to serverless and all that stuff. I think each of these softwares will also have to start moving to consumption-based pricing.
Claude's already doing it. So,
yeah,
for example, so you can get 2 models if you get Claude once a monthly, and seconds how many times you call my API, and I give you like a prepaid card, and it'll last you however.
Yeah, so Claude is different, right? So these are I'm talking about the companies like Salesforce, Snowflake,
Sure.
Salesforce, ServiceNow. These people, they're still on seat-based pricing. They have to figure out how do they survive when there is one agent That's basically extracting data, and there's no seats anymore, right? Maybe you charge for one agent, but then that's doing a job of whatever 10 or 20 salespeople were required to do the same job. So they may have to move towards consumption-based pricing as well. It's also the catch-22 for them. If they open up their let's say they make their software open in terms of any agent can come and grab the data, right? Then do they make their software irrelevant? All I need is access to the data. Right? But if they don't do it, if they restrict their APIs, then will customers stay with them? There are so many unknowns right now in terms of how this game will be played that I think we really don't know how it will pan out.
Yeah, I think they absolutely will have to. It's the same situation as Apple had with the iPod, right? The iPhone ate away the market for iPod, and unless they don't do it themselves, someone else will.
Someone else is going to do it. So right now, all these companies themselves are building agents, right, which will work within your system. So Salesforce has got Agentforce. I'm sure ServiceNow will have something. I don't own ServiceNow, and I think that's. I mean, I haven't heard Bill McDermott earnings call, etc. So I don't know, but I'm sure all these companies are building those agents which will allow you to automate a lot of stuff, right? Which, let's say, your humans salespeople were doing, or your IT staff was doing, or in some cases development team was doing. You can have the agents do it, but then they operate within the boundary of their own software. And now what Claude and these other models are trying to disrupt is we will have access to we can look into your Salesforce, see which customer you're talking about, what's the projection, when the contract renew to happen, or discuss. Then we can go to your Notion and bring up all the data in terms of all the notes captured by during the meeting minutes, or we can go to your Meet, Google Meet or Zoom, and get all the gist of discussions, can summarize it, and then we can also connect to your Box or OneDrive or Google Drive to pull up the contracts and bring everything together. Then the question is, then why would I want to use a Salesforce agent or Salesforce Agentforce, which basically only operates within its area? So I think the situation is very fluid. I really don't know. I don't think we can sit together and say how it will pan out, but these are the various I would say ways in which this new tech can disrupt. Right? And then at that point of a time, Salesforce just become a data entry screen, right? Where you just come and input data, and now all the analysis, all the knowledge or information we gleaned out from the base data happens at a different layer. It's mind-boggling thinking that suddenly all these big companies just become an infrastructure layer to provide the data and the context to the agents which will do all the analysis for you. Then, do I need a big Salesforce in which I only see 3 or 4 reports? Why do I want to pay for 400 reports that Salesforce has in it? And that's where the challenge. We don't know how this will pan out. Right? So, yeah, somebody says Slack. Yeah, it can also, whatever the Claude agent can also pull up the discussions that you have in your Slack thread. Or some folks may not be using Slack, they may be using other messaging tool. And then these agents become your integrators across all your applications.
In that case, nowadays, the agent, mostly people want to work in a backend, but there isn't like clear path forward how the agent work in a backend interact with people. Slack could be one of the possible interface out there.
Yeah, it could be, or they could create something new. Again, I think this is neither I have any idea. I don't think anyone knows how this will pan out.
Yeah.
But I think all that, at least I'm sure of, that our previous assumptions about the mode that these companies had built, those assumptions have been challenged.
Yes, I think the other way I look at this is, yeah, Vivek, I agree with your analysis on that, and I think the future is hard to get away, but at the same time, it's hard to grow. One thing I was thinking, Cloudy and all those AI companies show that develop, especially writing code, it become cheap, right?
Yeah.
But actually, if you look at back the history, there is something even cheaper, which is open source. It's been like 10, 15, 20 years. Why is not replacing like Salesforce, those SaaS companies? That's something like we need to analyze why.
Having worked spent a few years in a company that tried to capitalize on open source, I think there's only one company that probably had done it successfully, was Red Hat. Beyond that, a lot of other companies came and just couldn't make that model work out. I worked for Cloudera, wherein our products were built on Apache Hadoop. A lot of open source component around the big data. Didn't really work, couldn't make the model work out. You saw the same thing with Confluent. They basically they commercialized the open source of Apache Kafka, got bought over, couldn't survive, on its own. So there's something around this. It looks very enticing, but at some point of time, customers just not gonna take open source, and I don't know, they will need some guarantee of who's gonna update it and who's gonna maintain it. I think that's where a lot of the open source haven't really taken off, except I guess the Linux.
Yeah. Yeah, I agree. But my point is, who knows? Like, say AI generate code. You think quality is better than the open source? I doubt it.
Yeah, but we don't know. That's future is uncertain. All right. So let me go through some of the comments. Asif is sorry, before that, Aditya had some question. Selling a covered call spread, do you typically sell a short like around 30 delta? That depends on what's my outlook is. If it's only to get some premium, and I'm not really negative or want to reduce my overall deltas, it's just the premium harvesting, then I'll go out to 2016. But then I also need to be paid enough to do the trade. So there is no hard and fast rule depending on what is that I want to do right now. In some cases, I've done short strikes at 20 deltas. In some cases, I've also done 30 deltas. Like Ford, I've been selling covered call at 30, 40 deltas because I don't want to be long-term owner of Ford company anymore, but I don't want to sell the stock immediately, rather get some premium, let it be called away. It hasn't got called away yet because it's been a range bound. Hopefully my last tranche of Ford will get called away in February. We'll see. Asif is asking, SaaS is in catch 22. Any API they provide will make upper layer more powerful. Yeah, they're gonna make themselves irrelevant, but I don't think they can hold off for long, because customers will they'll move to solutions who will give them access to work with their agents. Slack as a chat app or something, I haven't used Slack I want to move away from Slack, but that's a separate discussion. Tableau hasn't been phased out. It was a king 10 years ago, number one BI reporting tool, but now being replaced by Microsoft Power BI. CRM, a lot of business logic, agentic workflow will make presentation and individual personalization. Yeah. As long as, but if agent doesn't have access to the business logic, I think that the question is even on the system of record, what if the agent can start to drive and, technically it may be right now, it may be impossible for agent to hold all the the end record into its memory or in caching, etc. But there are some concerns around it. What if the agents basically can hold all those records in memory? Right?
And
The base record, not the normalized one, not the additional stuff. I don't know. There's too much uncertainty right now.
Yeah, Vivek, I've even heard of an example which I can share. It's because with all the image sensing, now you can just plug in an agent directly with a camera, and now the agent understands what's happening inside the video recording. So now you actually having to put in information like how many Amazon parcels were delivered. The agent just looks at the video recording, figures out that data. And so now that's an example of where you don't need a system of record. Your video becomes your data, and the agent just derives data from it.
Yeah, see, I mean, this space has become a lot more interesting. So we'll see, how it moves. But definitely become interesting and challenging. Interesting for some and challenging for others. All right, let's talk about crypto. Maybe we'll come to earnings later. Yeah, stocks, buys and sells. I only bought Microsoft this week. I think much on the crypto side. Situation is not still good. Bitcoin is still below 70K. And I think I was tracking for every week to week basis. But we are down almost $1 trillion in 4 weeks. So $1 trillion of wealth, call it a whatever vapor wealth, but it is what it is. Has been evaporated from crypto market. Worse are these ones, the so-called digital asset treasuries, and a lot of influential people being part of this. So BMNR is like Tom Lee, and let's look into each one of these, right? So Tom Lee has been touting about BMNR, which is basically Ethereum treasury company. From 160 at some point of a time. Now we're looking at $16. A huge drawdowns on all of these companies. We have another one. We have MSTR, MicroStrategy. It jumped, I think, 25% on Friday after the sentiment improved a bit, but nowhere near. It used to trade around $500. Now it was down almost 80% with drawdowns. Got hammered.
You don't think that 25% was like a disproportionate to the amount that Bitcoin went up, and maybe a squeeze of some sort?
So Bitcoin went up, I think, around 20%, right? And this was again, I don't know in terms of this is a lot generally more volatile than what the Bitcoin is. So I'm not surprised that it is up 25%, to be very frank. I'm not surprised because it's been beaten down like almost 80% down from its all-time heights and drawdown of 80%. So 25% jump, I'm not surprised. It is generally more volatile.
How much more do you think it can go? I mean, I feel like that I see a level off at like 105 or something like that. If I looked at it correctly, I don't have the chart in front of me.
I have no idea how long I don't own this, but it will be highly dependent on the sentiment around the Bitcoin. Right. So the other thing is why this got also hammered is I think market was thinking if Bitcoin goes below its average purchase price, which was like $78,000, maybe 73 or somewhere, then MicroStrategy will have a trouble. That's a wrong assumption. They won't have any trouble in terms of servicing their debt. So the bankruptcy concerns are unfounded. Right? There are some media talking about that it will be in a financial trouble. That's not the case. Because MicroStrategy...
No, it has to be a long...
Sorry, go ahead.
I mean, the drawdown has to be for a longer period of time, and it has to be sustained for a longer period of time before they even have to worry about.
Correct. Because they raised enough cash and put it in, I think, US. They built up a cash reserve last year to service the dividends which they contractually obligated to pay on the preferred shares, and they can service the dividend for 2 years without raising any additional penny from the market. So from that perspective, I don't think there is there's a case for bankruptcy, because your debtors, you can only go bankrupt if you're not paid to the money that you owe to your debtors. In this case, they have enough reserve for 2 years. Other than that, most of the money that they've raised, the convertible bonds, there are zero coupon bonds, means you don't earn any, there's no commitment of any interest payments, any dividends on all that stuff. So the fact, the market was saying that they'll be in a financial trouble, they won't be. But the question is, if the Bitcoin stays in longer term downtrend, then they might, after 2 years, they'll figure out, okay, how to raise additional capital. So that will be a different discussion. But I don't think MicroStrategy is in trouble right now. Now, having said that, should you be trading 134 or 135 or 200? You should just go and look at it. What is MNAV, right? What's the multiple of Bitcoin value that it holds on its balance sheet? It's trading at probably maybe less than that. Earlier, it used to trade at 2x, 2.5x of the net asset value of Bitcoin that it holds in its balance sheet. Now, I don't know. Maybe someone else knows what's the current MNAV. And that means that it's equivalent to your price to book value. It may be trading at less than the value of Bitcoin it holds on its balance sheet. In that case, it might be a value play for some. But all these companies, digital asset treasury companies, got smoked. Narca, right? We're gonna hold Bitcoin balance sheet. Wow, someone paid $30 for it. Now it's trading for 30 cents. You need to understand in terms of which companies are got in. I also saw on Twitter, the screenshots of this story was covered either in Barron's or in Wall Street Journal about a fund manager who had put in his client's money on MSTR and how that money grew to $1 million. It was up like a few 100%. And now, the Twitter is basically having its field day saying, somebody please do a welfare check on their clients. It happens. There was a Harvard educated guy who basically took $700,000 of his parents' retirement money and he put in 2x leveraged MSTR. Don't do those stupid mistakes. Those are the stupid mistakes when you get too greedy. If you have a 2x leveraged MSTR ETF, you are already wiped out. It means 50% down. MSTR is 50% down. You're gone. You lost 100%. So a lot of these digital asset treasury companies currently are in huge drawdowns. Now, also because of the FASB accounting rule change, if you look, so MSTR actually had their earnings call on Thursday, right? And then they reported some $47 loss EPS, something like that. Let's look at MSTR. Let me exit this MSTR. Hopefully, it has the latest data. Quarterly Q4, yes. 42. Right. From previous quarter, it was $8 positive EPS. This quarter, it's like negative 42 EPS. But then if you enjoyed the ride while the Bitcoin is going up, now you get you get to feel the pain when Bitcoin is in 44% drawdown.
I think that there's some key things to pay attention for MSTR because they've widely advertised this $78,000 threshold. When we get closer to that, plus or minus 1,000 or 2,000, I expect there to be a decent jump in MSTR with maybe a day or two lag on that, if anything. So if anyone is playing MSTR, there is a play, I think, possibly.
Sure. I mean, I don't think they advertise. It's easy to calculate because they're all purchases are public. You can go and see what's their average Bitcoin buy prices. By the way, I mean their earning calls goes on for 2 hours, 3 hours long, and of course they also talk about a lot of other instruments, the credit instruments that they have, all the financial engineering that they do to generate those credit instruments on top of Bitcoin, which can give 11%, 12% credit income if you don't want to take the volatility. Yeah, if you're interested in that, they have a lot of products. It's now the MicroStrategy is no longer a data analysis company. I mean, they still have that business, but that's hardly any valuation is coming from their data analysis business. All the valuation or all the news or about MicroStrategies is how they're gonna create a business out of Bitcoin. So financial engineering to create various products. That's all their business is. So if you want to own it, you have to be comfortable. You need to understand, how they do all this stuff.
Should we eventually start looking at them like a bank at some point, where they just basically do crypto-backed loans all the time, and they make X amount of interest on these short and long-term loans, kind of thing? Like, is that sort of the direction we should evaluate them as?
So they don't have a bank license. So I'm not really bank, but yes, they will consider it like a Wall Street firm where they'll create a structured product based on the needs. So if you are let's say if you are a pension fund, you don't want to take the risk of Bitcoin going up or down, you just want to get your 11%, they can create a structured product which for 11% basically they use Bitcoin as a base and harness the volatility. I mean, these things happen all the time in Wall Street. These products are not accessible to, let's say, you and I, but they create these structured products based on the specific needs of big money, institutional money. And I think even there was a news, maybe BlackRock is creating a product similar to what MicroStrategy does, basically using Bitcoin as a backed assets and basically trying to harness the volatility of Bitcoin. Maybe they're trying to sell some covered calls on Bitcoin. I don't know. But I think BlackRock is trying to do something. But that's all these, I think MSTR is doing. Okay. So all these got smoked, all the digital asset treasuries. So if you own any one of these, to understand what the thesis is, I think on the BMNR, the thesis is pretty straightforward as of today. They hold Ethereum and then they generate yield because you can stake your Ethereum as a validator, and you get the yield that is coming out from ecosystem.
That's Tom Lee stuff, right? The PMNR, right?
Yes. Right. And again, I like Tom Lee. I like listening to his analysis of the market. One thing which we should not do is invest based on his targets. So Tom Lee target for 2025, Bitcoin was 250K. Didn't work out. Then it was blamed on October 10. Has someone really done a fact check of that October 10 software glitch? I somehow find very hard to believe, but I'm sure he's not lying. But I've not heard about anyone else, any other crypto, adjacent or crypto knowledgeable person talking about why the Bitcoin after October, in the October, November, why it had such a big drawdown. The only reason Tom gives is there was a mismatch in the pricing and then liquidated a lot of market makers. And he said this thing generally takes 8 to 10 weeks. So his expectation was that by end of Jan will be at 180K. Right? Didn't happen. Now I think I saw somewhere they're saying now the 180K is a Feb target. Again, don't invest based on his price targets. But yeah, he's been a big proponent of both Bitcoin and Ethereum. There was a news around Ethereum. I think there's a lot more confusion with like Buterin came and told that the whole L2 strategy is not working out. So that has thrown another wrench into the overall ecosystem. Again, if you want to be invested in this, you have to be comfortable and understand what's happening in the ecosystem. These are all these are all, I would say, your casino tickets, right? Go and play. That's okay. Don't put your food money in these. Unless you know where the ecosystem is going.
I think this also exposes a decent amount of weakness in Bitcoin and all the currencies for people that may be looking to accept Bitcoin more widely at the mall or anything like that. So we would get some, if crypto continue to go up, we would get some people saying like, oh, I'll start accepting Bitcoin at my restaurant and stuff like that. So I think that this drawback is going to make a lot of small companies or small businesses question whether they utilize it for that purpose.
I mean, I've seen the news of these companies, and you're right. When the price goes high, every company will try to become a player in this ecosystem, because once you start associating your name with this, there are a lot of degen investors who will buy your stock just because now you're doing something with Bitcoin. But I don't think anyone is actually have any plans to do with this in terms of buying and selling, right? Unless we change our tax laws. Because if buying and selling if Bitcoin is still considered as a capital asset, I don't want to be in the hook on, I bought a Starbucks and I have to, at the end of the year, I have to give a receipt to IRS listing on all my transactions. Right? You have a coffee 3-4 times a day, you're dead, right? So anyway, practically in US, nobody's going to buy or sell using Bitcoin unless we change the IRS rules around it. But yeah, it's a good news to get associated with it, because it will give you a bump to your stock price. So the companies will come and say, we are open. We can accept Bitcoin. That's okay. But nobody's anyway using to make any purchases. So the narrative around Bitcoin has shifted, saying it's a store of value. You just hold it. Don't trade it. Right? These are things to be hold forever, which got challenged over the last, I would say, 1 year. Ever since we started doing with the tariff stuff, I think immediately after tariff, Bitcoin did show up as a store of value, because everything else went down, Bitcoin went up. That was the first time that I've seen that it behaved in opposite way of NASDAQ. But since then, I think the rest of the world is still moved over to the gold as a store of value and not much on the Bitcoin side. So there is a lot of a narrative violation that has happened, saying if in the worst case, wherein the most powerful country in the world is basically causing so much disruption in the world order with the tariffs, and then Greenland, and then Venezuela, now Iran, I don't know what. But the world order has been disrupted, and the people around the world want to move towards some safer instrument than US Treasuries. And right now, they have chosen to put their faith in gold and silver. The numbers tell us. So the whole narrative of store of value hasn't really panned out just yet. Right? Third thing is around the whole concerns around their quantum will break encryption. Even if the Bitcoin protocol upgrade to quantum resistant algorithm, there are 30% of the wallets that can never be upgraded because they never moved. So maybe the owner is dead. So they are still vulnerable to being hacked by someone who has got access to quantum computing, right? Again, so these are the various things that are causing a concern among a lot of Bitcoin, I would say, holders. And coupled with the fact that a lot of OGs have sold, right? Because now it become a part of traditional financial media. And if you were OGs like inactive in a community on 2009, 2010, 2012, all the way up to 2020, I guess, wherein this was supposed to be a pure asset, uncorrupted by Wall Street, away from government. Now we invited Wall Street to play in this. We want government regulation. So a lot of people got dismayed by this. They said, come on, this is not why we worked on this forever. This is not why we put our wealth in it. Now it becomes a part of a Wall Street, and they have sold. So actually, during this drawdown, the boomers haven't sold. The boomers means those who invested through ETFs. They haven't sold much. It's the OGs or those who are holding the real Bitcoin, not real. I mean, yeah, it's all virtual, but the asset Bitcoin, they have sold. So yeah, so I think there are a lot of questions around the utility, encryption, quantum threat, and then it was supposed to be outside the system. Now it is deep in the system. That has changed the narrative. And some people don't want to be associated with what Bitcoin has now become. And they've sold off. Yeah, power to them. Yeah. So, yeah, things have changed. Jose says if there's systematic banking crisis or failure, Bitcoin will regain store of value narrative, as well as geopolitical turmoil. We hope. I mean, geopolitical issues we've already seen didn't work out, at least over the last 18 months. But we'll see. Again, this is a very new nascent asset. Will take years to even see whether it's going to stay true to its what we thought it could become or not. So this is not the thesis is not going to play out in a year or two. So if you want to be in this one, you have to have a really long-term thesis and ability to go through the drawdowns of 40-50%. And otherwise, watch from the sidelines. There are many other asset classes to invest in. All right, last thing, earnings. Before that, anything else? Any other topic you want to touch upon? What we got? 30 minutes, 28 minutes, close to. A few earnings to go through, and then we'll open up for breakout rooms. Any other thing? Because altcoins haven't performed. We have not seen the season of altcoin performance, which generally happens. I have no idea whether it's going to be in a bear market or not. My idea is just I'm not going to neither buy nor sell. Very tempted to see IBIT trading, in 30s, but I'm like, I don't want to be greedy, and nor want to be fearful and sell off. I have a 20-year thesis. I'll hold it for 20 years. If it goes down to zero, so be it.
Let's go to earnings.
All right, let's look at earnings. Next week. That also reminds me, no session next week. I'm traveling. So do whatever else you can do over the weekend. There will not be any session on next week. I'll also cancel it on the meetup so that it doesn't send you the reminder. Okay. But
is it possible to just leave the Zoom session so if anybody wants to join, they can do it, or do you have to be on the call to have a Zoom session started?
I can host a Zoom session if you want to talk. I also have it. I can set up one. So
okay, that sounds good then.
Sure.
Valentine's Day. Oh, this next week is Valentine. Yeah, it's Valentine's Day. But anyway,
so you're traveling for Valentine's. You're not, right?
I think Pranav is traveling for Valentine's Day. I didn't realize that next week Saturday is Valentine's. Oh, we're We're actually traveling mid of the week itself. So family travel plan. So won't be there for Saturday. All right. So what am I looking for? These are I'm Shopify, Arista. Shopify has been hammered too. And I couldn't find any news related to Shopify. Has someone found a news related to Shopify? Or is it just the general AI sentiment maybe? That all the software stocks got hammered. If you look at a Shopify, I don't know what's ailing Shopify as a stock.
But it's been down for a while. Like it's down. I'm assuming because Amazon's down, everything that's competing with it is also down. Mercado Libre is down. Like there's a lot of stock.
So Mercado Libre I can understand a bit because when dollar becomes strong, you will see Mercado Libre, which basically has a earnings in currency other than dollar, so that will become weak. And the reverse is true. If dollar becomes weak, you will see Mercado Libre stock going higher. I don't know about Shopify. Maybe I want to check how much is the international revenue for Shopify. It's like non-dollar denominated. But that's been down from close to 180, 190 to almost $110. I didn't see any news related to it, so I assume maybe it is, given the weakness in all the software companies, is this what's causing Shopify to fall? Maybe. So anyway, we'll go through I'll look through Shopify, Arista Network, Pinterest, and then Coinbase. I don't hold Coinbase, but it'll give you some idea around the sentiment on crypto side, because this is the only pure play crypto company which is in IPO. Any other companies that you guys are interested in or are watching? Then AppLovin is there.
S&P Global.
Or you hold S&P Global? I don't.
I'm just watching it. So
didn't it get?
It's Tuesday. Yeah.
Herbert SGPI, because what's a
SPGI, I think.
SPGI. Yeah. So SPGI factor, these are considered to be a pretty stable company. If you look at a lot of these in value investors, like Dave Cantasoria talk about.
It's like Moody's and FICO, right?
Yeah,
I'm
Moody's,
also watching
FICO.
those,
yeah. These all fall in the same bucket.
The ratings, right?
Yeah,
they be the credit ratings right there. Yeah.
Because you need them.
Correct.
If you're doing any debt offering, you need them. So they got a pretty, I say, captive business. But they all got hammered. Well, I don't know.
Right. So the question right now is, if it's going to pass 439, it's going to go down to the 400 level, right? So looks like it. So.
Yeah. And this supposed to be a pretty stable company. Nice growth, growing their dividend, decent, consistently good operating free cash flow, margin, and all that stuff. I mean, some of these companies are like a staples for a lot of those value-oriented funds and value-oriented portfolio managers.
Anything that's of interest right here?
Sorry, for me?
Well, based on this earnings calendar right here, anything that you think has high volatility?
Oh, yeah, Robinhood is right there.
Oh, there you go. That one.
Coinbase is there. Right? These are all crypto space. Then you have these high beta stocks.
Nebius.
Like Nebius is there. Let's see what happens to HubSpot, because HubSpot again, market saying that it's given for dead. Why do we need a HubSpot? So we'll see what they have to do. I thought Confluent got bought over by IBM, but maybe the transaction hasn't concluded yet, because I see Confluent reporting its earnings separately. I think a lot of retail favorite volatile stocks are there. We got Oscar Health. Let's see what Datadog. Yeah.
You don't think HubSpot is ever going to come back? Why is it dead?
I guess the question is, these are like marketing automation. Why do you need? Okay, whether it'll come back or not is a separate question. The currently the market is assumed. Why do I need a HubSpot if my agents can do these things, or I can vibe code and build this software? I think that's a concern. What's a HubSpot? Oh my God. That is like, wow, they're giving up.
That's getting beat up.
Oh, this is where they came IPO? It's a pretty new IPO company then. I've not owned it, so maybe that is. It goes all of. Oh no. Let's see if I can pull all the way back to. Oh no, it's been an older company. Okay, so now it is back to 2021, or even lesser than that.
I have a question. What do you think about Robinhood right now? I mean, I was looking at their EPS estimates for the coming year, and it doesn't seem like there's a lot of growth compared to like last year coming in.
So Robinhood being a financial services company, probably they're becoming more as a bank. EPS is probably not the right way to even evaluate the company, because the banks, we don't look at EPS. We really want to evaluate banks. I think price to book value is what investors will generally look at. And my only concern with Robinhood is a lot of their revenue comes from options income. Mm-hmm. The fee, the money that they make when the traders trade options, and the other one is crypto. Right?
Yeah.
And now, depending on how the market sentiments is, and mostly driven by the retail customers, and so that's a very fickle customer base that you have.
I mean, do you think they're gonna still be like high beta and like have a lot of upside? Because like I feel like a lot of the upside from before is because they were growing so fast, and now they're not growing as fast. So
how much the growth? Let's go back and look at. I mean, they're still growing at a decent pace.
But that's something like, what are they? What's their 2026 estimate for growth?
Let's look at the forecast. %. Yeah, you're right.
So that's a big haircut from before.
Yeah, that's a big haircut, and even future
so it's
growth.
Like, is that going to cap the upside, or do you think they're still going to benefit just because everyone's like, oh, tech?
So I don't know about this year or the next.
Okay.
But my reason why I'm not owned or don't want to own Robinhood is that in a larger scheme of things, in a longer period, they want to become bank. That's the only gameplay they're gonna, and then their revenues will be similar to how the big financial services companies' revenues are. Okay.
Yeah, so less volatile, basically.
Yeah, it will become less volatile. Yeah, you can have this play for next 2, 3, 4 years, but eventually their whole idea is that they just can't survive, and they understand that their customer base is very fickle. To build a great business, they have to attract more stable customer base. That's why they've been adding all those retirement accounts and try to get more stable customer base and become a bank itself. Right? And in that case, you will be able to generate the returns which are, financial services returns are.
But yeah, but basically it's not going to have a year like it had last year, right? I mean, last year had a crazy year. Like what did they do? Like 35 to, they 5x in the year.
Stock price, I have no idea. Stock price is all dependent on what the individual investors feel on that particular day.
But that's what I'm saying. But a lot of it's also Ford. A lot of that premium is on Ford growth, right? It's pricing in we're going to grow a lot or whatever, right? Like if they don't have that, then you're not going to have the price go up as much.
Yeah, that is true. I would rather be more willing to take on maybe Coinbase, because that's at least a little different. It's completely in a different industry. If it works out, works out. Now we don't. Then Robinhood, which is trying to become a general financial services industry right now.
But they're kind of merging, right? Like they're both eating into each other's pie, because Coinbase is I think they're going to start offering equities on Coinbase. So they're trying to like eat into Robinhood's pie and vice versa.
Yeah, and
they're
then
both doing prediction markets, right? Like they're going after the same thing. Like
yeah, and all of them will become Schwab after 10 years.
yeah, when everyone gets old, right? Gray haired millennial.
Yeah. So, cool. So let's look at a few earnings, starting with Google. Oh, come on. So there is nothing wrong that I found on Google. Some good things are annual revenues up, now crossed $400 billion. Google Cloud, it grew 48%. Right. Amazon, we'll look at Amazon. Amazon grew 24%. Google Cloud grew almost 50% year over year, which was amazing. One area where if I have to be really picky about Google is YouTube. YouTube grew only 9%. But if you look into the, I don't think I have that screenshot right here. Maybe in another post. YouTube used to grow in double digits, but at least in this quarter, Q4, year on year, the growth was only 9%, which is understandable. Because last year we had tailwinds. We are lapping up the quarter where we had a lot of political ads going on because of the no, that wasn't the last year. That was the prior year. I have to figure out why this is only 9%. But that's the only area where I was little being nitpicky. Otherwise, I think all the stuff is good. YouTube revenue exceeded $60 billion for the full year 2025. You know where that puts it? It puts it bigger than Netflix. So YouTube is the biggest streaming service in the world, not Netflix. Though nobody talks about YouTube when you're talking about streaming services. Now, what spooked the markets? Because the shares were down, whatever, 10% or whatever percent, is the CapEx is up 95%. Not only this is what spooked them. They gave a guidance of CapEx from $175 to $185 billion versus market was expecting $115 billion. So the sentiments in the markets has changed. In 2024, the more you spend, or even in 2025, the more you spend, the more market rewarded you. Companies will come and announce we're going to spend $50 billion, $60 billion in NVIDIA chips, and market will reward you. Now, 2026, eventually market is thinking, that's great, where's my ROI? And if they don't see a line of sight to the ROI, they're punishing the companies. And this is what happened with the Alphabet was, come on, $107 to $185 billion. It means your future cash flow will be constrained, your future earnings will be low, and the stock got punished. But I think if anyone can make this whole AI play work, don't want to count out Google. I'm pretty happy with whatever they have reported. And the other thing, which I don't think in this post, but I did in subsequent, was their operating margins on the Google Cloud have consistently been increasing. First time they became profitable at an operating basis was in, I think, 2023. Now they have a increasing revenue and the margin is also increasing. That's a good thing, and you would want to invest in that business. So I'm okay for Google to invest as long as they can continue to increase their margins. What we would hate is that you invest, but at investors lower than the current margin, then is a value destruction. Yeah. Any questions on Google? We'll jump on to the next one. Uber.
Do you think is it fairly priced?
I didn't run it through the pricing from a pricing perspective, but let's look at GOOGL. Oops. What are we looking at? We're looking at 28 forward PE, which is, I think S&P is trading at 25 or something. It's not that expensive. Right. It's not that expensive. You look at a PEG 1.78. Yeah, it is decently priced, I would say. I've not, really looked at it in terms of from a discounted cash flow, but that will tell from a valuation perspective, pricing perspective, seems to be okay compared to the rest of the market. So I'm okay to hold or add. I think I did a put spread on Google, and we get assigned, I'll probably buy some more. Let's talk about Uber. Uber had a CFO change. Prashant, the current CFO, he is leaving. He hasn't announced, but he did mention that he's going for service to American citizens. So maybe he's taking some government first. I have no idea. But we'll see. But we got a new CFO coming in. I found it, I only heard in one conference call, so it's too early to pass any judgment on it, but seemed to be pretty decent guy in terms of his focus on where he wants to take the company, and more importantly on capital allocation, which is where over the last few years, both Dara and the current CFO gave very clear indication to the street in terms of what they want to do with capital, how they want to allocate it, and that's what got me bullish on Uber more, and Balaji continuing the same path, right? So what I did not like on this one, so revenue was up, beat on revenue, but you can ignore this. Net income was down 96%. It is because of revaluation equity investment, so rather focus on operating income. Operating income was up nicely. Right? They also generated $2.8 billion free cash flow. All business metrics look good. Trips were up, bookings were up, mobility revenue up. There is nothing that I did not like. Only thing which was, I think the market didn't like, was their guidance on EPS, which was lower than expected, and stock was shot down 5%. I think the biggest concern market has is how it is going to play out when the AV space, right? That's the biggest overhang. But if you listen into the calls, not only just the latest one, but even the previous one, Uber wants to become a demand aggregator, becomes a marketplace in which all other AV players can come and play with it, and that might be difficult to replace. Even though maybe robot taxis will come in, but we'll see. So I don't think it'll become irrelevant once the robot taxi is in, because AVs, so Waymo cars on Waymo's platform, their own platform, have a lower utilization than Waymo's car on Uber platform, right? So they are able to manage the demand and the supply because they have perfected it over years in much better way than any other new standalone player. And of course, they have a tie-up across the world with a lot of these AV players, and yeah, there's nothing to dislike about it. Uber is like Expedia for hotels for EV players. Yeah, do hotels have their own website? Sure, but they still want to. These aggregators still have a value, and of course, there's another connection is the current CEO of Uber was CEO of Expedia, so he knows he knows this space well. He knows this business model really well, and I'll own it. All right, next one. PayPal or PayPal? How about Tesla coming onto the market too? Yeah, I mean, that's what the market is saying. What if the robo-taxi is coming? Right. First of all, we'll see when the robo-taxis will come in, but I think there is a space for more than one players. And right now, the concern that market also has is that the cars, etc., that they cost a lot, but eventually, his thought process is all this will become financialized in terms of like Marriott. Let's say Marriott and the Hiltons, they don't own the hotels. The hotels are owned by REITs, right? Real estate investment trusts. Those are owned by REITs, and they say these all cars will be owned by some private equity firm, some REIT firm. Like data centers are not owned by, let's say, Meta, etc. They're owned by REITs. So I say we don't have, so from a pricing or balance sheet perspective, Uber won't have to own this fleet of cars. They will be all be owned by REITs, and basically they'll become a capital light business. That's a longer term plan. So the whole concern around that robot taxis are much cheaper to operate because they will cost less, whereas Waymos, etc., are very expensive because they have a lot more LiDAR sensors and hence capital heavy. That probably won't be the case for Uber. Right? We'll see. Let robotaxi come in. All right, PayPal. So PayPal, again, big management changes, CEO is out. And then they brought in Enrique Lores. I never heard of this gentleman, but then when I looked at it, he was the CEO of HP, and now he will be joining PayPal. The reason, and the stock was down some maybe 20%. It is because of, let me jump to the guidance, right? They gave guidance that transaction margin dollars will decline, non-GAAP EPS will decline, this will decline, that will decline. Market really didn't like it. Stock was down 20%, and the CEO is out. And CEO is out, if you recall, CEO has been there for 2.5 years only. And I think the bad part of this is he cleaned up the whole leadership and brought in his own folks, new leadership team. And now I think once he is out, probably other leaders will also leave, right? Because now the new CEO might want to bring in his folks. So the big concern that I'll have is there's no one who actually been in PayPal or have understood the history of a company and the DNA of a company in the leadership. That'll be my concern. The other big thing is the guide for decline in EPS came in after 2 consecutive raises in EPS. So if you go back and look at Q3, they raised their guidance from whatever they told previously. Q2, they did the same thing. So this came as a big surprise to me, right? Which is, come on, what happened? Last 2 quarters, you were raising your guidance. So maybe there's a lesson for CEO to learn. And this also reminds me, because he's the first time CEO, I think more than, of course, you have to meet your numbers, but I think one big job of CEO is how to communicate to investors. And I think Alec Chris probably, this is just my reading, he missed the mark there. Remember in January, I think 2024, he came and told that PayPal will shock the world, right? And then there was a 6 minutes of recording that came out, which was a big disaster from a comms department and how you communicate to Wall Street, right? Some companies would want to go, little, call it sandbagging, call it prudence, or call it I want to give myself margin for error. Chris was really always very bullish. So I think maybe we'll figure out in terms of the communication perspective. I don't know, why did you have to raise your EPS guidance? Maybe you could have been a little more, balanced about your view. And then the street wouldn't have been surprised as much as it did in this quarter. Even I think maybe board of governors, the board of directors as well. So anyway, revenue was a slight miss from what the street was expecting, but these all numbers I think didn't matter much. The much bigger idea was, have you lost your mojo, and is there anything that this company can salvage? Good thing about the company is that it still generates good amount of cash flow. Right? So their guidance on the adjusted cash flow is still $6 billion. And if you look into the past year, they've been using all this cash flow to buy away the shares. So, well, the stock has been down. It could become a classic play for those cigar butt investors. They're guiding to $6 billion of free cash flow, assuming that we'll still be able to get this, because last year also we were able to get this. And they're gonna use that all for buying back your shares. Just from valuation perspective, they are trading at a free cash flow and yield of 18% or 16%. Right? Which is where 2023 Alibaba was trading. Right? When China was uninvestable and stock got beaten down, it was trading at a free cash flow yield of 16%. And we talked about it, took a position on it. That turned out to be really good. But the question on the PayPal would be, are the projections of $6 billion free cash flow, will you still be able to maintain year after year? It's no longer a growth story. The idea is, if you can just manage your business the way it is currently being managed and not let it deteriorate, then it's available at a very great, very decent, very attractive valuation. Assuming that it's just grows at 2%, 3%, right? The inflation rate, then the stock is trading at a very attractive valuation. If I did not have a position on it, I probably would be tempted to maybe start a position at this point of a time. But I'm not. I already have it in my portfolio, so I'm not going to do that. But it's a valuation perspective. It's very attractive. Now, the other thing is, look at the choice of the new CEO. This CEO is not known for growth. So he's been in HP, cleaned it up. So my assumption is he's going to come in. PayPal still has some good assets. They own Venmo. So, which is basically what pains me is, for millennials and older, they use PayPal, PayPal application. For the younger generation, Gen Z and younger, they use Venmo, which is also owned by PayPal. And they still haven't figured out how to, generate good amount of or grow the business, having both the full spectrum of generation covered on it. And then on the enterprise side, they bought Braintree, which is one of the leaders on the payment processing. Right? But yeah, it is what it is. Not a growth story unless we see a turnaround in the business, which, given the fact that they got Enrique, I think that the thesis is maybe clean it up, maybe sell it to private equity, maybe just grow. Let it continue at its current pace and just return the capital to shareholders. If you continue to generate $6 billion of cash flow, if you can sustain that, then even without any growth or any change, your market cap, you basically free cash flow per share just continue to go high and high because of the share buybacks, which is fine. There are companies that don't grow but have become a compounder because they've been buying back all the shares from the free cash flow that they've been generating. Like cigarette companies, the overall revenue has been going down, but they've been a compounder in terms of a stock because they bought back a lot of shares. Well, there are a lot of companies that do that. I guess AutoZone is one of them, or one of these auto spare part company. These are like a share cannibals. They eat so much of the shares itself that I think one of them has gotten maybe 70. They reduced their share count by 70%. Right. So we'll see. A lot of thoughts around PayPal came from some of the OGs, that have now moved on and founded another companies, saying this is a great story. They were the first in this, but they just couldn't capitalize on it. So right now it's a classic value play. You're getting at a very attractive yield of 16-18%. And if the new CEO doesn't kill it, at least sustain where it is, I think it's a decent buy, but not a growth company anymore. All right. Anything else on PayPal? All right, 2 more to go. Then I'll go through some of those comments. Palantir. There is same story every quarter when you hear me or Palantir. There's nothing that I did not like in this earnings. I mean, they just blew the expectations away. Way beyond what the street had expected. Only thing I don't like on this one is a share price. Revenue grew 70%. So freak. I have to adjust it with EPS. I'll have to stock-based compensation, but they become a little more conservative in it. So yeah, I'll give them free cash flow. Right? And they also guided. The main thing was, where's my guidance here? Oh, I don't have it here. Oh, so they guided to 70% growth even for the Q1. Billings are up 91%. So amazing business, but very expensive stock. So yeah, I mean, the stock was up, and then I think after the whole the SaaS meltdown, the stock sold off. Right now it is trading at not SaaS, Palantir, right? PLTR. $137. I'm not rushing to sell puts on it yet. It's still expensive. For me, it's been expensive for almost 18 months. Look at it. I just can't. $70 of price to sales. Very expensive stock, but growing like crazy, which is what I mean. Attract a lot of growth investors who want to just look at the revenue and say, "Oh my gosh, it's continue to grow like this. Yeah, we want to get behind it." Lastly is Amazon. So what's on Amazon? Beat on revenue, EPS was slight miss. I don't know why did the market punish it like 10%. Market was expecting $1.96 of EPS. It delivered $1.95. So one is that. Other thing is market, again, the same story, huge CapEx. They guided to CapEx of $200 billion CapEx. So again, the question is, hey, where's an ROI and all that? Right now, the market sentiment on the CapEx has completely flipped. If you're spending a lot, market is punishing you. But otherwise, I think everything else was good on Amazon. generated $16 billion free cash flow. More important, the metric that market looks at it is AWS growth, 24%. That's the fastest growth in last 13 quarters. Right? Ad revenue is up 22%. Their chips are fully subscribed. I mean, all the chips are in use. Now the chip business is almost annual run rate of $10 billion and grew in triple digits. So what market doesn't like is because you're spending so much of a capex and all the stuff, your operating income is not going to grow much as compared to 2025. So while you have a good revenue growth, your margins are constrained because of all this spending. But if you know about Amazon and the history of Amazon, they are okay to get a hit on margins if they think that they can spend to capture the future revenue or the future growth. They've done it earlier for building the e-commerce logistics play, 2013 or 2016, somewhere where they moved from 2-day delivery to 1-day delivery, then to same-day delivery, and invested a lot more in logistics infrastructure. Market punished it. Now they want to do the same thing with an AI, want to build the infrastructure to become a big player in AI, which means the margins will be constrained. Sometimes market likes it, sometimes market doesn't like it, right? So anyway, I don't think there was anything wrong in this quarterly report. So I had a short put which I rolled out. I still have a bullish stance on Amazon, because given all other companies, of all these Mag 7s, Amazon and Microsoft, they have not performed. Microsoft is even trailing S&P. If we look at it maybe for last 3-4 years. So, which is amazing. So that concludes our earnings.
So just general, all three of them, right? Amazon, Microsoft, and Google, I think all three got punished because of large capex plans. Any thoughts? What's your thoughts on go forward for all three? Would you say, like you were just talking about, long-term play? Amazon invests. Would you say that's for all three, or just general on?
See, I think Google has got. I think even for all three, I would say I think this is the right thing to do. Microsoft, little concern is around not just the capex, but a lot of the revenue. 45% of the revenue is tied to OpenAI. That's if OpenAI can get the funding, what they've been raising around the fund, and the concerns around OpenAI, if that's are allayed, Microsoft will come back right up. But there is no other company that knows how to sell to enterprise customers better than Microsoft. Right? So even if not OpenAI, they'll have other customers that will, they'll be able to sell to. So I am not concerned about any of these three companies. So their spending that they're doing, because they have a demand. It's not like during 2000. I mean, there is a lot of comparison between we had so much of a capex in 2000, didn't really pan out. We had a dark fibers in 2000. Means the telecom companies built it and then say, let's build, they'll come. And they never came. So a lot of those fiber optic cables were dark cables, like they were never used. But if you listen to the calls of all the CEOs, they say we already have a demand. It's not we are not building in anticipation of the demand. We already have a demand for which we need to invest right now. Now the question is, will the demand because once you invest, that investment will take 5 years, 10 years to pay out or get your ROI. I don't know how much is the ROI cycle on this AI investments is. Maybe a little less. The question is, will the demand continue to be there or not? I think that's probably something that I may have to look into it. But otherwise, they are they are not able to service the demand that they have right now. So those who got burnt by the capex in 2000, it's not the same comparison. They're building to service the demand.
Yeah, I think they're down by between 10 and 30% from their 52 weeks high, right? I think Alphabet is down 10, Amazon more like 20, Microsoft down 30. Just thoughts longer term. Do you think those are good points to go into them? You think they'll go down more, or?
I'm looking at, let's say, Microsoft is currently almost 30% drawdown.
Yeah,
Let's go back to 3 years. This is a max drawdown that we have seen in 3 years. On Microsoft. Let me go to 5 year. Okay, this was 2022, I guess. Yeah, so except the 2022, I think this is the max drawdown. It's available at a reasonable valuation. Oh, that's why I bought Microsoft, but then my holding period will be 10 years minimum. And I'm okay to wait on it. And anyway, I'll be reducing my cost basis by selling options against my long holdings. So I'm okay to wait on Microsoft.
What about the other two?
Amazon, again, I have a short put on Amazon, because Amazon didn't do much over the last 1 year. Right, whereas a lot of other Max 7s and the money rotated into a lot of other companies, nothing came to. Amazon, Microsoft didn't perform. Yeah, so I'm more bullish on Microsoft as comparatively. I'm more bullish on Microsoft than Amazon.
I was looking at its 52-week high for Amazon. So it's that was around 250. It's down around 210. So about 20, not quite, but close to 20% down from its 52-week high, right?
Yeah, it's 18%. Yeah, it's down 18% from its recent high.
Yeah. I think Google's down about 10%.
Yeah, Google hasn't corrected that much. Google had a decent run up, right? Over the last year, it was up like 60%. But then Google is Google. And they're growing their cloud revenue by 50%. So you can't write them off. And if there is any decent competition for any of these Claude or OpenAI, it's Gemini. So I think I'm still, all these three companies, I'm still bullish, still hold it.
And Vivek, all this capital expenditure, do these reports go into what exactly are they spending these hundreds of billions of dollars on? Is it land? Is it what? Is it chips? Is it?
Yeah. So
what exactly is it?
So they do talk about it. If you look into their earnings transcript, let's say Amazon mentioned that significant is going to AI, generative AI and infrastructure for their own stuff. And then basically AWS data centers, power capacity, custom Trainium chips and Graviton chips, which is their CPU chips, right? So majority of this CapEx spending is all going in creating capacity in their data centers, buying NVIDIA chips, right? So here's the deal. Things like if you look into this, NVIDIA will make money because anyway they will get, these companies will buy NVIDIA chips, or in case of Amazon, probably they'll also use their Trainium and all that stuff. But that's where they're spending a lot of their money on, in building up the infrastructure, either for themselves, because they want to use AI for their own in-house, which I think is a lesser portion of the CapEx, but for building capacity for the cloud, let's say for Azure, so that their customers can use it. For Microsoft, 45% is OpenAI, 55% is other customers. All the CapEx spending is on these. Because, I mean, what else do they have? These are capital light businesses. Right? So all the CapEx spending that is going on is going in data centers. Other than that, they don't have any other stuff. Yeah, a little bit of a property lease and all that, but that's very small.
Yeah, and I think that's what it was, right? If you think about, you have the physical building, you have the power and the cooling and the cabling and everything else, and then finally you get down to the actual computers with the actual chips, right? And so it becomes, okay, out of the 200 billion, how much is it in chips to, you know, NVIDIA and whoever else is making it versus how much is the overhead to for the physical infrastructure of the building itself and everything that goes into it, right? I don't think I've ever seen that published by any of the hyperscalers. They just give that one number that covers everything. Right?
No, I think maybe 2 years ago, Sequoia had one report in which they were looking at if you're spending $100 on NVIDIA chips, then your overall spending for it to make work, it's around $200. I think in 2023, where some of the Sequoia analysts were questioning around $600 billion, how are you going to fill that $600 billion of committed capex over the next few years? And that's where I remember, I think they talked about if you spend dollar on chips, it means your overall data center will be around 2x.
Okay.
So if you're looking at saying how much is going on chips, and this is a very, high level, something I remember from reading the Sequoia letter was maybe half of them are going towards chips. Now that could be NVIDIA chips or that could be Trainium chips. That's what we don't know. Right. So the moment you realize, the moment I think Google announced this big capex, Google got punished, but Broadcom went up.
Yeah.
Yeah, because then if Google is gonna, develop more their TPUs, it's gonna create more revenue for Broadcom. So Broadcom was up after hours.
Yeah, it's kind of funny. 2 days ago, both NVIDIA and Broadcom were down. I think, and then they're down like 7, 8, 9%, and then the next day, I guess based on the Amazon and other spending plans, they were back up that 8, 10%, right? So really wild swings based on what they think where the money is going. So,
and if you want to even or reduce the risk around whether it's going to be Trainium, whether it's going to be Tensor processing, or whether it's going to be AMD or NVIDIA, I would rather go back further down in the supply chain and just pick, let's say, TSM. Don't care whether it's AMD, whether it's Trainium, whether it's Google, whether it's Apple. They are all roads lead to TSM for building the chips. Or maybe some of them little bit tributary of a road leads to Intel. Eventually chips have to be made. There is no other companies who can do it. So, all right, so that's around earnings and finishes our discussion today. I'll open the breakout rooms, and what else we want to talk about?